fundsupermart.com.
After 2 consecutive years of underperformance, China has become our most favored single-country equity market. But there's more than one way to capture the upside potential of the China market. The first is through investing in the H-shares or red chips market, and the second is through investing in the A-shares market. Most of the Chinese equity funds on our platform invest in China through mainland Chinese companies which are listed in Hong Kong. These are H-shares. But we also have funds which invest directly into mainland China's A-shares market using a QFII license. So today I will outline the unique features and investment opportunities that lie in the China A-shares market. First, let's take a look at some of the reasons that lead us to favor the China equity market. We think that the economic growth story is set to continue. Even though China lowered its GDP growth target from 8% to 7.5%, this does not imply that economic growth will slow to the 7.5% level. Instead, we think that this reflects the government's effort to manage markets' expectations, as well as to focus on quality economic growth drivers. The second reason is that we think that loose monetary policy will give the market a strong upwards momentum. Both H-shares and A-shares investors will benefit from these two positive factors. However, there are also some important differences between investing in the H-shares and A-shares market. Even though there are some companies which are listed in both mainland China and Hong Kong, there are over 2,000 companies listed in the A-shares market. This means that the opportunities in the A-shares markets are much more fruitful. Now, if we use the CSI 300 index as a benchmark for the A-shares market and the HSML 100 index as a benchmark for the H-shares and red chips market, then another important difference between these two markets is in their sector allocation. While both indices are heavily weighted in financials, the HSML 100 index has a larger weighting in the energy and telecommunications sector. On the other hand, the CSI 300 index has a larger weighting in the industrials and materials sector, a ratio which reflects China's GDP composition more accurately. Another feature worth noting is that the consumer sector makes up a larger proportion on the CSI 300 index, which means that it will also have larger correlations with China's domestic consumption growth trends. We also think that domestic consumption will become increasingly important to the Chinese economy. From an investor's point of view, another important difference between the A-shares and H-shares or red chips market is in their valuations. Now, even though both of these markets recorded a year-to-date rally, their valuations are still extremely attractive. The HSML 100 index's forward PE is currently at 9.8 times, which is 1 standard deviation below the historical mean. But if we look at the A-shares market, valuations are even more attractive. Now, some investors may be aware that the A-shares market typically trades at a premium to the H-shares market. Now, this is because mainland China restricts foreign investors from participating in local equity markets. And this means that, unlike other equity markets, the A-shares market is dominated by retail investors. Furthermore, investment choices are limited in China. And this means that retail investors typically put a large amount of their funds into equity markets, pushing up valuations of the A-shares market. We can see that in 2007, this premium had reached 74%. But recently, the A-shares premium has declined and reached just 9%, which is significantly lower than the historical average of 28%. Now, if we take a look at the A-shares market's forward PE in the past couple of years, we can see that it's currently at extremely attractive levels. The A-shares PE started to fall below its historical average in 2010. Then towards the end of last year, it fell below the 12.2 times level, which is 1 standard deviation below the historical mean. Now, despite a year-to-date rally, the market's valuation is still at a 12.5% discount from the 12.2 times level. Now, since the CSI 300 index is mainly composed of financial institutions and industrials companies, another suitable measure of valuation we can use is the price-to-book or PB ratio. Since the return on equity, or ROE, is a profitability measure and PB is a valuations measure, we can expect that when ROE increases, the PB ratio should increase at the same time, which is what we saw during the period of 2006 to 2008. However, in 2010, when we started seeing the A-shares ROE increase, indicating that profitability was increasing, we saw that at the same time the PB ratio was falling, which meant that shares were getting even cheaper. This rare occurrence is another reason that leads us to conclude that the China A-shares market valuation is currently extremely attractive. Finally, let me remind investors that on our platform, we currently have 2 Chinese equity funds which invest directly into the mainland China's A-shares market using a QFII license.